When it comes to investing, the financial world is filled with a variety of instruments, each offering its own unique blend of advantages and challenges. Among the most popular investment vehicles are stocks, indexes, and exchange-traded funds, or ETFs. To truly understand how these differ, it's important to examine three critical aspects: their underlying structure, their profit margins, and their liquidity. Each of these factors can significantly impact an investor's strategy, risk tolerance, and potential returns. Let's begin with stocks. When you purchase a stock, you're essentially buying a piece of ownership in a single company. This could be a technology giant, a small-cap startup, or a well-established blue-chip firm. The key to stocks is their specificity. Your investment is tied directly to the performance of that company. Profit margin in the context of stocks typically refers to the company's own profitability, which is often expressed as net income divided by revenue. This figure is crucial for investors, as a company with a high profit margin is generally more efficient and potentially more resilient in tough times. The company's profit margin, however, is not the same as your investment's profit margin, which depends on the price at which you buy and sell the stock, including any dividends received. Liquidity, in the case of stocks, refers to how quickly and easily shares can be bought or sold in the market without causing a significant impact on the price. Highly traded stocks, such as those listed on major exchanges like the New York Stock Exchange or NASDAQ, tend to be very liquid. This means you can usually enter or exit a position with minimal delay or price fluctuation. However, liquidity can vary greatly between companies. Large, well-known firms typically have millions of shares traded daily, while smaller companies might have fewer transactions, making it harder to buy or sell large quantities without affecting the market price. Now, let's shift our focus to indexes. An index is not an investment you can purchase directly. Rather, it's a statistical measure that tracks the performance of a group of stocks. Examples include the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. These indexes represent baskets of stocks that reflect the overall performance of certain sectors or the market as a whole. Because indexes are merely benchmarks, they don't have their own profit margins or liquidity in the traditional sense. Instead, their value is derived from the collective performance of their underlying components. However, investors can gain exposure to indexes through index funds or ETFs that aim to replicate the performance of these benchmarks. In this way, the profit margin for an index-based investment will mirror the average returns of the companies that comprise the index. If the majority of companies in the S&P 500 have strong profit margins, the index's overall performance will likely reflect that strength. Liquidity, on the other hand, depends on the vehicle used to invest in the index. For example, an ETF that tracks the S&P 500 will have its own liquidity profile, which is often very high due to significant trading volume and investor interest. This leads us to ETFs, or exchange-traded funds. ETFs are investment funds that are listed and traded on stock exchanges, much like individual stocks. They are designed to track the performance of a specific index, sector, commodity, or asset class. When you buy shares of an ETF, you're effectively investing in a diversified portfolio of securities. The profit margin of an ETF is not a measure of the fund itself, but rather a reflection of the underlying assets it holds. For example, an ETF that tracks technology companies will indirectly expose you to the profit margins of those firms. Your actual profit comes from the change in the ETF's share price, and, in some cases, from distributions such as dividends or interest income. One major advantage of ETFs is their liquidity. Because they are traded on major exchanges throughout the trading day, ETFs can be bought and sold as easily as individual stocks. This is known as intraday liquidity. The liquidity of an ETF is influenced by two factors: the trading volume of the ETF itself and the liquidity of the underlying assets it holds. Popular ETFs that track major indexes, such as the SPDR S&P 500 ETF, SPY, are among the most liquid securities in the world. However, specialty ETFs that focus on niche markets or less traded assets may have lower liquidity, which could result in wider bid-ask spreads and potentially higher trading costs. Comparing profit margins across these three vehicles can be complex. Stocks provide the clearest picture, as you can directly analyze a company's financial statements to determine its margins. For indexes and ETFs, profit margin is more of an aggregate concept, representing the average profitability of the underlying components. When you invest in an ETF or an index fund, you're essentially betting on the collective performance of a group of companies, rather than the success or failure of a single entity. Liquidity, on the other hand, is more straightforward to compare. Blue-chip stocks and major ETFs are typically highly liquid, allowing investors to enter and exit positions quickly and efficiently. Indexes themselves are not directly traded, so liquidity is only relevant in the context of index funds or ETFs that track these benchmarks. In summary, stocks offer the potential for high rewards but come with higher risk, as your investment depends on the fortunes of a single company. Their liquidity can vary, but major stocks are typically easy to trade. Indexes provide a snapshot of the market or a sector's performance, but cannot be bought directly. Investors must use index funds or ETFs. Profit margins and liquidity in this case to depend on the composition and structure of the fund. ETFs combine the best elements of both worlds: the diversification of an index and the trading flexibility of individual stocks. Their liquidity is often excellent, and they offer a simple way to gain exposure to broad markets or specific themes. Ultimately, the choice between stocks, indexes, and ETFs comes down to your investment goals, risk tolerance, and desired level of involvement. Understanding the differences in profit margins and liquidity can help you make informed decisions, ensuring your portfolio aligns with your long-term financial objectives. Whether you prefer the hands-on approach of stock picking, the broad coverage of index investing, or the versatility of ETFs, each vehicle offers unique opportunities for growth and wealth creation.